All financial markets are volatile and have good days and bad days. Markets can be unpredictable and illogical at the best of times, driven by a huge number of variables, ever-changing global events, and by emotional and sometimes irrational human beings. Market timing is therefore very difficult, but some people still do try to time the market by avoiding buying stocks at their peak and waiting to buy during heavy dips. In this video, I'll run a backdated experiment to see what would happen if you tried to time the market. That is, to predict when the share price is cheap and steer clear of days where the price is high. I'll show what happens if you are successful at timing the market, what happens if you buy at market peaks, and what happens if you just dollar cost average, which is investing equal sums of money at regular intervals. I'll use 3 stocks to run through this experiment: Colgate, PepsiCo, and Waste Management. I chose these completely at random, just with them being popular dividend stocks. I do hold positions in PepsiCo and Waste Management, but not in Colgate. I wanted to include a company that I don't own, just to try and avoid any bias in choosing them. And I genuinely had no idea what the results would be. To perform this experiment, there'll be 3 protagonists to the story. All 3 protagonists will invest $500 every month for 20 years, for a total of $120,000, each using different investment methods. Our first protagonist is Consistent Christopher. Consistent Christopher invests his $500 each and every month without fail. Whatever the price of the stock is on the first trading day of the month, he buys as many shares as his $500 will allow him, including fractional shares. Any dividends he receives will be reinvested back into his portfolio on the first day of each month also. Our second protagonist is Mystic Mary. Mystic Mary has an incredible gift of being able to predict market crashes perfectly. She saves her $500 each month in the bank and waits for the perfect opportunity to buy the dip following a severe price reduction. She's the world's best market timer. She receives her dividends but doesn't reinvest them straight away, and instead waits again until the next market crash. And for completeness, any cash left at the end of the 20 years is just invested into shares. So looking at this share price graph as an example, Mystic Mary would invest here, here, and here. Our third protagonist is Bad Luck Barry. Bad Luck Barry thinks he has the same gift as Mystic Mary, but the reality is he gets it completely wrong every time, and instead of buying at market cycle low points, accidentally ends up buying during market cycle peaks. He's the world's worst market timer. Similar to Mystic Mary, he saves his dividends with his $500 a month and waits for the next opportunity. And again, for completeness, any cash left at the end of the 20 years is just invested into shares. So, looking at the same share price graph as an example, Bad Luck Barry would invest here, here, and here. Oh dear. So, what are the results at the end of 20 years for each investment method? So, if we look at the data from Colgate first of all, this is a graph of the share price over the 20 years that our protagonists will be investing over. As we know, Consistent Christopher will just invest his $500 each month, regardless of share price, on the first day of every month. Mystic Mary, with her impeccable timing, will save her $500 each month and then deploy all of these savings at the market dips. Here, 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 and here. Bad Luck Barry, with his unfortunate timing, saves his $500 each month and then deploys all of his savings at the market peaks. Here, 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 and here. So, at the end of the 20 years, all 3 protagonists have invested $120,000 in total, but all 3 have very different final amounts. So what I've done is take the monthly share prices, so the average, the opening, the high, and the low, along with the dividends paid. Then using this information, I've worked out what would happen for each of our protagonists. So for example, with Consistent Christopher, we take his $500 monthly investment and just divide by the opening share price for the month. For Bad Luck Barry, we save up his cash and dividends until we hit one of the market peaks on the graph. where he uses these savings to purchase as many shares as possible at the month's high price. And for Mystic Mary, we save up her cash and dividends until we hit one of the market dips on the graph, before again purchasing as many shares as her savings allows at the month's low price. So at the end of the 20 years, Consistent Christopher is left with $276,196.92. Mystic Mary is left with $260,229.24. And Bad Luck Barry is left with $172,563.02. They have all made a return on their $120,000, but whereas Bad Luck Barry's investment only returned $52,562, Mystic Mary earned $140,229 by being able to perfectly time the market. But Consistent Christopher, who just invested his $500 every month, earned $156,196. Now let's see what happened when investing in waste management. This is the graph of the share price over the 20 years that our protagonists will be investing over. Again, Consistent Christopher will just invest his $500 each month. Mystic Mary will perfectly time the market dips, buying here, 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 and here. And Bad Luck Barry will buy at market peaks, buying here, 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 and here. So, at the end of the 20 years, all three protagonists have invested $120,000 in total, but again, all three have very different final amounts. Consistent Christopher is left with $551,384. Mystic Mary is left with $530,451. And Bad Luck Barry is left with $343,982. So again, they have all made a return on their $120,000, but whereas Bad Luck Barry's investment returned $223,982, Mystic Mary earned $410,451 by being able to perfectly time the market. But Consistent Christopher, who just invested his $500 every month, is the clear winner again, earning $431,384. Now, just for good measure, let's take a look at the results for PepsiCo. Let's again look at the graph of the share price over the 20 years that our protagonists will be investing over. Again, Consistent Christopher will just invest his $500 each month. Mystic Mary will perfectly time the market dips, buying here, 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 and here. And Bad Luck Barry will buy at market peaks, buying here, 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 and here. So, at the end of the 20 years, all three protagonists have invested $120,000 in total, but again, all three have noticeably different final amounts. Consistent Christopher is left with $298,980. Mystic Mary is left with $329,714. And Bad Luck Barry is left with $207,421. They have all made a return on their $120,000 investment, but whereas Bad Luck Barry's investment returned $87,421, Mystic Mary earned $209,714 by being able to perfectly time the market. Consistent Christopher, who just invested his $500 every month, didn't manage to beat Mystic Mary this time and earned $178,979. So why are the final figures for all the three protagonists so different? This all boils down to the time that each protagonist held shares for. The longer they held the shares, the more they could benefit from the share price appreciation. Also, the longer they held the shares for, the more dividends they were eligible for. And then receiving those dividends meant that they could purchase more shares that pay more dividends, and so the snowball effect of compounding dividends could take hold. Consistent Christopher's method was basically a dollar cost averaging strategy, where any market volatility is smoothed out by investing equal sums of cash at regular intervals. I do appreciate that if I was to test this theory with more stocks, I may come across some more examples where Mystic Mary would have had a higher return than consistent Christopher. But looking at the difference in returns from my experiment between regular investing and perfect timing, I can't imagine there'd be too much difference. And I've yet to meet anyone that is able to perfectly time a market cycle. So what can we conclude from the video? The main takeaway should be that the classic saying, "It's not about timing the market, but time in the market," rings true. The data backs up the premise that investing consistently and regularly should be the most effective way of building wealth over the long term. Sometimes even if you were able to perfectly predict market dips, which is near impossible. Consistent dollar cost averaging might not be exciting, and you might not be able to brag to friends about the massive gains you've made in a week, but it is a proven method over a long time horizon. There are huge organizations with billions of dollars of capital at their disposal and access to the most advanced technology, people, and research. And even with those resources available to them, they are still unable to time the market perfectly over time. No one can be Mystic Mary, and if you try, then you might end up being Bad Luck Barry. Personally, I do think it can be useful to save a little bit of cash to capitalize on small market dips over the short term, but I think to hold large amounts of cash over a long period, waiting for that perfect crash, won't be as effective as consistently buying each and every month. The results of this experiment do reinforce my approach to investing, which is to basically buy good companies each and every month, and then hold them for the long term, reinvesting all dividends along the way. To me, building wealth really is that simple, and the data backs up this methodology over the long term. I hope you found this video useful and informative. If you have, then please like the video and subscribe to the channel. I'd also be really interested to hear your thoughts on the video in the comments section below. Thanks again for watching, and I'll see you on the next video.